So moved.
Yes.
Yes. Is your mic on, sir?
And I was the one listening yesterday complaining the mics weren't on. Okay, sorry about that. So again, welcome our friends from Empower and Milliman today. Before we get started here, we're going to go through and have everyone introduce themselves and their titles. And we'll start with Jason, please.
Good morning, everyone. As Jim said, my name's Jason Tether. I'm with Mass Mutual Great Lakes. It's an agency of Mass Mutual. I've been helping the county plans here for the last 17 years. I used to work with Steve Oman, who is one of my mentors. Steve has been involved with the county really since its infancy when the plan started with Mass Mutual. Still, just for those that are new, Mass Mutual had Lenawee County plans as an entirety, is one of our oldest client plans on the books. So the defined benefit plans, the defined contribution plans have a really good history with Mass Mutual. For those of you that are new, Mass Mutual was sold to Empower about 4 years ago at this point. At that point in time, I was introduced to Michelle, and then we used Milliman as the administrator for the defined benefit plans for all the county plans. Thank you so much.
Good morning. My name is Michelle Equali. I have the privilege of functioning as the relationship manager for your county plans. So as we go through today in the content, I'll be presenting the Q2 plan performance reports. We'll look at some plan level data and some participant data, and then hopefully from there we could drive some planning and, accolades and kudos to the team in areas where it's going really well.
Good morning. I'm Becky Seelman. I'm your actuary from Milliman. And after almost 40 years of helping other people plan for a secure retirement, I am retiring next March. Let the record show I did a little happy dance. So I brought with me today Jack Shimoleski, who is a principal of Milliman. We have been working together on this year's work for the plan so that next year he will be fully up to speed. And this was an excellent opportunity to introduce you all to one another. And Jack is going to do the presentation of the 2025 valuation results for you in just a little bit. Jack?
Thank you, Becky. As Becky mentioned, I work at Milliman, Principal and Consulting Actuary in the Milwaukee, Wisconsin office. I've known Becky for over 20 years, and I'm very excited to be here today and present the results to you. And yes, thank you, Becky. One of the reasons I was brought along with this plan is I have a number of other Michigan public entities that I'm the actuary for as well. So I have a lot of experience here in Michigan.
Perfect. Thank you. Administrator Murphy. Your mic on.
Thank you, Chairman. My name is Kim Murphy. I am the county administrator. I've been the county administrator for 3 years and was the deputy for 13 years prior to that. I do have to indicate, and I apologize in advance, I have a conference call that has just literally before I walked in here, I have to take at 11 o'clock. So I'm going to bounce out just before that, but I will come back in as soon as that meeting is complete. So if you see me walking out, it's not because we had a bad report or anything, and so I'm sure everything looked great. I just want to let you know. Thank you.
Well, good morning. I'm Roxanne Holloway, County Clerk. Been with the county for 41 years, so dreaming of retirement. So glad to be here today, and thank you for all your work that you do. We appreciate it.
Good morning. I'm Kevin Martis. I'm District 7 County Commissioner. I chair the Ways and Means Committee, and I guess this is halfway through my second term.
I'm Jacob Pfeiffer. I'm captain with the Sheriff's Office. Been with them for 22 years.
Deputy Administrator.
Good morning. My name is Shannon Elliott. I'm the Deputy Administrator for Lenawee County. I've been with the county for 19 years, 3 of which as a deputy, and prior to that, I worked in the probate and juvenile courts.
Good morning, Jackie Wise, Lenawee County Prosecutor.
Carissa Zupke, I work in the administrator's office.
Bev Ehlers, Human Resource Director, and I've been working with Jason ever since he came on board with Steve. And I have been with the county for 43 years this month.
Congratulations. Jim Van Doren, I'm Chairman of the Board of Commissioners, second time around. I didn't learn anything the first time, so I'm trying the second time. So we'll see how that goes. And over here, we have our Communication Department, Jen. Yeah. Okay, so that pulls up. I'm going to turn it over to our people at Empower. So,
Thank you. Thank you, committee. On the line, I have a very talented colleague, Joe Fine. Joe is prepared to take us through the Q4 2025 economic and market overview. We have about 15 minutes prepared. We've provided more slides than we're going to go into review, but we thought that giving you at least the context to read on your own would be helpful. And then we'll just have Joe take us through a narrative. At any point, interrupt with questions. The markets can be a little bit confusing right now. So if there's any curiosity or questions, just stop the conversation and we'll go into detail. Joe, can we do an audio test? Are you okay? Joe, you might need to unmute. Unless he's muted as a guest. Okay, Joe, you might be ready.
Okay.
Can we test again?
Yeah, can you hear me?
Hear you great. The floor is yours.
Okay. Thank you. Thank you, everyone. If we look at page 1 of the quarterly outlook, you could see that it's kind of divided into 3 sections: where we were a quarter ago, what's been going on since, and where we are in terms of at least as late as September. Obviously, markets have gotten choppier since the end of the quarter, first couple of weeks of the month. But things are, in terms of market conditions, are holding up relatively well. So earnings continue to pour in. I'm on the right-hand side now in terms of where we are. This is speaking to, we're kind of seeing a fractured economy, if you will, where at high-end consumers are feeling good about the economy and doing well, particularly because of the wealth effect that homeowners have seen, right? But lower middle income consumers are probably not feeling as great. And that would also include, because of some of the inflation pressures that have been felt due to, the ongoing tariffs. Now, as the last bullet indicates, tariff pressures could emerge. This turned out to be prophetic. That's what's been going on the past week or so with U.S. and China tensions building again. So that's why markets have gotten choppy. In terms of, I'm going to turn to page 2. We'll talk about the government shutdown in a couple of minutes. But as we could see here, valuations in terms of U.S. stocks, particularly certain segments, became a concern. But earnings right now are winning out over valuations. And again, in spite of the tariff situation, and the rising tensions between China and the U.S. As it points out here, the last bullet, healthcare and small cap, U.S. small cap stocks in particular are more reasonably valued. In terms of bond market, and we'll have more both on stocks and bonds in a couple of minutes. In terms of the bond market, I'm sure everyone is aware, the Fed has begun a rate cutting cycle, partly due to some of the pressures the Fed has been feeling. But regardless, that is what has been going on. So rates have been coming down at the shorter end. At the intermediate to longer end of the curve, they have not been coming down too much. But the yield curve has been normalizing nevertheless, and we've seen, pretty good returns from bonds on a total return basis, both the third quarter and still so far this month as well. We'll talk about what markets are expecting in a few minutes as well. I'm turning to page 3 now. And there's more news on the AI front this morning. Continues to have a good run, although there has been choppiness so far this month, but the momentum generally does continue. And, politically, tariffs are looming. And as we know, there's been a government shutdown. Now, historically, government shutdowns have not impacted market returns very much. So we'll see how long this shutdown goes on and, what kind of impacts are felt throughout the economy as we move forward. I think some of the comments we made about, consumers, lower to middle income wage earners could come into play there as well. So in terms of where we think things are headed in terms of ranges, right? Because whenever we're talking economic outlooks, there are a range of outcomes, hard to, make predictions with certainty. So on page 4, we're showing you where we are in terms of what could go wrong, what could go right, and what has been occurring. So we do see more of a range of outcomes, if you will, or fatter tails or extremes, right? So which means there are more risks both to the upside and the downside, if you will. So some of those are felt here, like if something would occur in terms of the sudden loss of wealth from high income consumers. So I know there was one of the calls we did yesterday for one of the county boards spoke a little bit about the housing market, right? So that's an area where things could go wrong, but thinking about where we are in terms of housing real estate across the country, there are things are changing somewhat depending on what geographic areas we look at, but all in, inventory is very low, right? So that is keeping the housing market afloat. Many individuals have lower rate mortgages, and that has kept a lid on what would be available for sale in terms of existing housing. So as a result, the consumer is remaining resilient, again, more so at the higher end than the lower medium end. And, the Fed markets are pricing, and we'll see this in a few minutes, that the Fed is going to continue to cut rates steadily from here on. So if that continues, that's going to be a help to markets and consumers in general. So unless there are questions, we're going to look at just several more slides. On page 5, spoke about this a little bit in terms of where valuations are, and certainly U.S. large cap equity. This is an area where valuations have been very high as opposed to U.S. small and mid-cap, smaller and mid-sized companies, which did do well in the third quarter and have been holding up fairly well so far this month. As you may be aware, foreign markets, both developed foreign markets and emerging markets, have had really strong years. So that has not been the case relative to U.S. stocks in quite some time. So welcome development for those that have diversified portfolios, but from a valuation perspective, makes them more neutral as opposed to positive from a valuation standpoint. And then fixed income, as we alluded to, at the shorter end of the curve, really positive for where rates are headed, right? Lower. However, longer term treasuries, less so. And similarly for U.S. credit. So all in, that's where we are on the bond market. And if we turn now to page 7, you could see some of the metrics that we were talking about in terms of U.S. equities and valuations being stretched. So if you just scan across, you could see that we are at very high valuations for 8 of the 10 stock market sectors listed here, right? So overall, large U.S. stocks overvalued. I believe on the first page, there was a bullet with respect to healthcare being undervalued, but pretty much the rest of the sectors at high valuations. And then finally, on page 8, as I alluded to, futures market, bond market is expecting the Fed to continue to loosen in terms of monetary policy. And so the next rate cut is, markets have it virtually locked in. And I believe for December futures, 60 to 70% probability that the Fed will cut again with additional cuts through the end of 2026. So that's what we are seeing. Again, in terms of plan investments and assets hovering, near highs that were reached the middle of last week, and all in spite of the recent choppiness, a really solid market returns on a year-to-date basis. So that concludes the prepared remarks. I don't know if there are any questions or comments.
Questions? Looks like everyone's fine.
Okay,
We thank you for the overview.
thank you. Oh, thank you for having me. The rest of the committee meeting.
Thank you, Joe.
Okay.
So next up, we're going to have Jack go through the valuation for the defined benefit plan.
All right. right, perfect. Thank you. So switching gears to the January 1, 2025 actuarial valuation. As a refresher and a reminder, we do a valuation annually, so once a year, and use a snapshot as of January 1st each year. So this is data using, information as of December 31st, January 1st. So we are about, 9.5 months later now. So it's a little bit stale, but it's a great view annually to see how the plan is tracking and how it's trending forward. A little bit of a reminder of what the valuation does and what we're going to talk about today. First, we'll look at how we determine the plan's liability. We'll look at the data as of January 1, the reconciliation, what occurred with that data in 2024 or during 2024, and then how that information impacted your liabilities during the year from January 1, 2024 to January 1, 2025. The second component are the plan's assets. So again, we'll look at that investment performance during 2024, how the asset balances changed during the year, and then how that portfolio is invested, how that impacts the discount rate and everything we're using in that valuation to determine your funded status. And then bringing those two components together, looking at how the plan is funded, so your liabilities and assets, how that impacts your actuarially determined contribution for the year, and how that all comes together to look at what those contributions are going forward. We know that we have the pleasure of doing this on a daily basis, and we're really excited about that, but we know that you only do this maybe once or twice a year. So if you do have any questions throughout the presentation, please ask, and we're happy to discuss them in a little bit more detail. On the right side there, a few of the key takeaways. So if you want to kind of just focus on these 3 points, maybe you can doze off a little bit for a few minutes after that, but really kind of focus on these 3 items. The assets during 2024 earned almost 12%. That is a fantastic return for the year. That really helps the funded status. Speaking of the funded status, it did improve from 81% up to 82.3%. So there's a few things that impacted there that we'll talk about, but again, the plan's on the right track going forward, getting that funded status improved. And then some of those reasons for that improvement on top of the asset return are that the experience gains from mortality being a little bit higher than we expected helped the plan. That was offset a little bit by higher than expected salary increases. So those higher salary increases increased the liability of the plan, which brought that funded status down. So those two kind of offset each other a little bit. Moving to page 1. We'll look a little bit on the data, the membership of the plan. So overall, from 24 to 25, the member count decreased from 503 to 484. We expect that decrease to continue. The plan was frozen depending on the group to new members in the early 2000s. So there won't be any new participants, and that count will continue to decrease as we go out into the future. Out of the active group, which was 66 as of the beginning of the year, 9 of those actives retired, and that count is now down to 53 as of January 1, 2025. That is less than expected. We did expect around 35 people to retire. So 9 out of 35, not quite as many as we assumed, and people really obviously love working here and continue to work here, which is fantastic as well. We'll look at the data for the actives in a little bit. On top of that, we did have 21 retirees or beneficiaries that were in pay pass away during the year, which is a little bit more than expected, which, did help the liability come down a little bit for the plan. Focusing on the bottom of the page now, looking at just the 53 active members, you can see since the plan was closed to new membership in the early 2000s, most of those members, or all of them, have been here for at least 20 years. And we can see a lot of them are getting towards that retirement age. So the normal retirement age for sheriffs is 55 years old with 25 years of service, or 65 years old with 8 years of service. And then all of the others are rule of 85, which is age plus service, greater or equal to 85, or age 65 with 8 years of service. So many of this group is at normal retirement, which is why we had assumed a lot of them would retire, but they continue on. One other thing to focus on, again, we mentioned before that payroll for the 53 current members increased more than our assumed 3.25%. I looked back a couple of previous years, and there was actually, the salary increases were slightly lower than what we had assumed. With the higher inflation currently, we're seeing that trend quite a bit amongst our plans, that the increases are higher just during this year. That 3.25% is a long-term assumption. And so we do expect a little volatility and difference for year over year, but over the long term, we expect that to hold true. Yes.
I just wanted to add, you may or may not be aware of, for the active member status, we went through a wage and compensation study. And we are, in 2026, will be our third and final year of that implementation. So across the board, there were a number of employees that received pay grade adjustments and other types of adjustments, which is probably adding to that higher level of salary than what you had originally projected.
Fantastic. Thank you for letting me know. And so we'd probably expect to see that same thing maybe next year and maybe even the year after with small losses for that. So thank you. Switching gears now to page 2. So we talked about the membership and the data. Now we'll look at the assets. Top left on this page, we're looking at the historical returns over the last 5 years. You can see great news on this page. For the 5 years, we're double-digit asset returns, which is just phenomenal and fantastic. But there is 1 year, 2022, which is consistent with all of our plans, that there's just nowhere to hide in the market that year. And we had -16, almost 17% return in that year. For this plan, we do use an expected return on assets of 6.75%. And looking at this time period, you can see in the middle of that graph, compounded annual return over this 5-year period is 6.29. So again, slightly lower than what we're assuming. So there's a small asset loss over this time period from what's assumed. Top right on this page is a reconciliation from the beginning of the year to the end of the year. And one of the things that I want to point out here are the board contributions of almost 2.5 million. That is significantly higher than the actuarially determined contribution, which is another reason why that funded status improved year over year. So kudos to you for making those contributions, improving that funded status for the plan. On the bottom left, just looking at, for the valuation purposes, the dark green column under each one are the market value of assets. So that's the asset value as of the beginning of each year. And then the lighter green columns are the actuarial value of assets. One of the things that we do with the valuation each year is we smooth the assets over a 5-year period. And so the reasoning for that is to make sure that there's not a lot of volatility with the contribution calculations. So this asset smoothing, you can see if you look at the light green bars over this time period, they're a lot more smooth than those dark green bars. The dark green bars bounce all over, whereas that light green kind of is nice and smooth. That helps keeps the volatility of the contributions down. So that's the amount that we use when determining the contribution amount. Next page, we're sticking with the assets. The top of page 3 here, we're looking at your target asset allocation. And so when we're looking at this graph, on the right, we can see the blue bubbles. Those are generally the equities. And on the left, that's the fixed income of your portfolio. So, and the size of the bubbles are determining what percentage of that portfolio is each one of those asset classes. So you can see U.S. government credit bonds, about 25.6% of your portfolio. Another one is maybe large as foreign developed equity, over 20%. So you can see you have a nice, great mix in your asset portfolio. Again, keeping the volatility of the asset return down and making sure that everything's on track for your plan. One of the things that we do with each valuation is we take your asset portfolio, and now looking down at the bottom of this page, that we use that information along with Milliman's capital market assumptions to help determine what the expected return on assets is for each year. And this is a very important assumption that we use, because this is also used to discount your future payouts to calculate your liability. And so looking at this graph and taking your asset allocation, we tend to look at it over a long period of time. So we don't know what's going to happen for asset returns in year one. I don't think anybody really does, but the longer out we look, the more certainty there is with where we believe that those asset returns over that time horizon will be. And so looking out over 30 years, that median, that 50th percentile bar, so looking at the middle bar, we'd expect over 30 years with your asset allocation that the plan would earn approximately 6.8% compounded over that time period. And so then when we look at your discount rate of 6.75%, we believe that that's reasonable. Looking at the last couple of years, the 6.8% median was also true for 2023. It was 6.9% for 2022. Back in 2021, it was 6.2%. So something that we continue to monitor each year. And, some of the other plans, I believe, in Lenawee County use 6.5%. That's something that, maybe if when the markets come back down, something that we would explore to maybe move that down to 6.5%, depending on if that occurs in the future. But that's a discussion for another day. Everything looks good now. On page 4, we look at now how the funded status of the plan, how the accrued liability is within the plan. So top left graph, looking at the accrued liability over the last 5 years, and you can see it's grown slightly. It's actually plateaued and it's come down the last few years. Focusing on 2025 valuation, you can see that the accrued liability is 97.3 million. We did expect 97.5 million. So it's slightly lower than what we were expecting. Some of the reasons for that are the mortality gain of around 900,000. So liability is less than we were assuming due to the mortality experience. There's also around $100,000 gain from the retirement, so less people retiring than we assumed. And then that was offset by around 900,000 from the compensation increases. So $200,000 less than we assumed, which is always great news and very close to what we were assuming. So experience is tending to track along with what our assumptions are. On the right there is just looking at the same accrued liability, but it's split out by member group. So we have the different member statuses, the active members, the opt-out employees, those that are in pay, and then the terminated members, which they're no longer working for the county, but are due a pension plan, a benefit later in life at retirement. One of the things that I focused on in this section is that in 2021, out of your total liability, approximately 59% was from the retiree or in pay group, and that's grown to 66% over this 5-year period, and we would expect that to continue to increase over time as more and more people retire. One of the good things with that is there's a lot less volatility when it comes to that group. You're either living or dying to continue that benefit. With the actives and terminated vested, there's a lot more situations that can impact the liability, such as compensation increases when they retire, things like that. So that'll help keep the volatility down as we move forward as well. Switching to the bottom of the page, some good news here, looking at the unfunded liability. So now we're taking that accrued liability, removing the actuarial value of assets, and it's trending definitely in the right direction. So 2023, we had a high water mark of 20.3 million underfunded. That's down to 17.2 million underfunded. That slight gain in the accrued liability was one reason why. And I think the second larger reason why is that contribution amount greater than the ADC or the actuarially determined contribution has another impact. And another way to look at that is the right there, the funded ratio has increased, from 79.3 in 2023 up to 82.3 as of 1/1/25. Page 5 looks at that actuarially determined contribution, and there's 3 components to determine that contribution amount. The first being, and the largest being that light green box, and that's the amortization of the unfunded accrued liability. This is a closed period, so we're amortizing it over 16 years as of 1/1/25. That continues to decrease year over year. And it's a level percent of pay using a 1.75% growth rate. So as the funded status continues to improve, that amount should continue to shrink, but using a closed amortization period, that amortization period shrinks too. So if the unfunded amount stays the same, the amortization amount would actually increase because there's a shorter time to pay off that amount. So hopefully we continue that improvement on the funded status, and that amount continues to remain relatively steady or shrink as it gets closer to 100% funded. The second component down at the bottom, the darker green, is the normal cost. So that is the annual accruals for your active members. And one of the things that we'll focus on here, you can see that it's been negative or very close to zero over the last few years. And the reason for that is that the employee contributions cover approximately 100% of the normal cost. So that's a good position in the fact that the liabilities aren't increasing generally with those active employee accruals. And then the final component is the interest. That's that orange bar at the top. And so we're using 1 year of interest at 6.75% because we're calculating that contribution amount as of 2025 is being paid in 2026. So we have 1 year of interest there. And then just focusing there at the bottom is just that same amount as the total of those three components. And you can see that that contribution amount has decreased now the last couple of years, which is great. And now the last slide, just looking at page 6, some people love all the colors in the graphs. Other people really focus on the numbers. And so these are the exact same information, just having the numbers there with you, broken out from everything that we talked about throughout the presentation. The last few pages, we don't have to go over them, are just caveats and things like that that are necessary for our reports. Does anybody have any questions?
Commissioner Martis.
This is my first time through, so it may be naive, but my understanding, this is a defined benefit plan that no longer takes new members, right?
Correct.
And at some point, there will no longer be anybody eligible to draw. They will have presumably expired.
That is a long, long way away, but
It certainly is.
yes. Yep.
But is it possible that there's then residual value there, or is that all distributed out to the beneficiaries?
Yeah, that's a great question. And currently the plan is 80, a little over 80% funded. And so I think that's a story for, we hope to get to that question in the future, but I think with great planning and things like that, the plan would be that, there's an exact amount of assets along with an exact amount of liability, and, there are no residual assets at the end.
Thank you.
But likely it will be decades. The youngest active member of the plan is still in their early 40s and is likely to live, we hope, into their 90s or beyond.
I'll be long gone and have the
I was gonna say,
residuals.
Commissioner Martis won't be here by then.
Right. But this is one of the reasons why it is important to keep an eye on this and have a checkup every year. I always feel like this process is sort of like we're a ship on the ocean heading for the far shore. And once a year, we stop, drop anchor, and see where we are, because we know that there are, let's see how far we could go with this metaphor, there are winds and currents that are blowing us off course. And we want to make sure that we are making course corrections with plenty of time so that we get where we want to go in a nice orderly fashion. So a point will come, I imagine, but maybe it won't be for another 30 years, where you'll say there are only a handful of retirees left in this plan. Maybe we should start thinking about a different approach. Hopefully at that point, the plan is fully funded. You have $1 of assets for every $1 of liabilities, but you should be at some point starting to think about, are we taking the appropriate amount of investment risk, for instance? Do we have the appropriate amount of liquidity in our investments and that sort of thing? So we have a long ways to go, but that's why we get together once a year and think about it and talk about it and make sure that everyone is comfortable with the plan for the plan.
Any others?
Okay, so next up is the InvestNet report. Before I begin though, I think I'd like to share with you, I pulled the plan assets as of Tuesday before we came down. And as of Tuesday, the plan's up to about $88 million. So even from January 1st till now, you've seen a large spike based on contributions and the performance of the funds housed within the plan. Right. For the new folks in the room, if you've never heard of InvestNet, I'd like to explain quickly sort of how we got to InvestNet. Just a quick brief overview. Many years ago, Steve and Mass Mutual and myself and the committee members and the board members would review the plan, and Mass Mutual would give some ideas on particular funds that the board members might want to consider either replacing or reallocating some of the funds to, and the board members would have to vote and decide which funds they felt most comfortable with. And that went on for many decades, quite frankly. And we started to hear feedback of, we only do this once a year. We are not investment experts. We're not really comfortable taking on the fiduciary risk or liability of voting as board members and committee members on which fund's going to be best for the plan and for the participants. And so the industry started offering fiduciary services where you could go out and hire someone to do either 321 services or 338 services. And the difference is with the 338, InvestNet actually is acting as the investment fiduciary for the plan. So the board members, the committee members no longer have to vote on which funds, which weightings, which allocation, how to rebalance. That is the job in its entirety for InvestNet. When we first started, it was Mesero, and Jim and Bev, you might recall, Mesero was doing a fine job, but InvestNet came into the equation, was able to do it for a little bit less cost for the plan. And Mass Mutual had negotiated corporate group discounts for all Mass Mutual plan clients. And so we switched from Mesero to InvestNet, and InvestNet has been doing it ever since. Their whole model is predicated on Model 3, which was voted upon based by the board and committee members many years ago. And Model 3 says that we want to have a 65-35 or a 60-40 asset allocation weighting between equities and bonds or fixed income. InvestNet has the variance of a 5% leeway either way. So they can go from 65 to 70 or from 65 to 60, either way, in either direction, based on where they think the market's going to go, based on our actuarial assumed rate of return of 6.75. Their goal is to try to maintain performance that's better than that. That's simply stating their objective. So the first page just says InvestNet. The second page is the 68-page report that all of you have access to, both here in the room and online. Please know that this can become overwhelming. I'm not going to spend a minute per page. I've only been given 10 minutes for this section, but please know that they decide which funds and we can't even counter them because they are the hired 338. So there have been times where they'll suggest the fund change, and Michelle and I will get on the phone with them and just ask some additional questions on why are we going in this direction or what are your thoughts? And they'll sort of give us sort of like what Joe did earlier, their background on why they think it makes sense to go from one fund to another. But we really don't have a say to say no. That's their job. That's what they've been hired to do. So the first page, yep, thank you so much. This just gives you an idea of all the fund offerings, but the funds that show total assets, those are the funds currently that are being utilized in the plan. So it tells you the name of the fund, the ticker symbol, the amount of total assets that are allocated to that particular fund. And then to the far right, it gives you the total plan asset allocation based on capital market. So you can see you are an extremely diversified portfolio as a plan. And that's their goal. 65-35 range, but going to be truly diversified against all capital markets. At the second page, I'm sorry, go to the fourth page, and it just shows you the total. This is as of June. So as of June 30th, we had, I'm sorry, keep on going to the next page. It shows a total of 84 million. One more. So as of June 30th, we were at 84 million. As of Tuesday, we're at roughly 88 million. So once again, the market conditions are doing well for this plan based on the current weighting being is what it is. Okay. The next page, they show some of the activity in the funds. So when you see rebalancing of funds, they'll tell you which sectors they're rebalancing to and from and the dollar amount. They'll show you the weighting again, once again, between the different category and capital markets, starting with US large and going all the way down to commodities. Then they show quarter over quarter. So in this particular report, it's showing you the December 30th, 2023, then the December 31st, 2024, then June of this year. And they show you what the dollar amount is per fund. And if there's a fund change, you'll see that reference between one fund, 1 quarter or 1 year over one fund to the next. So you can see where some of the changes have occurred. And then if we could go, so that goes on for the next couple of pages. Portfolio snapshot. Once again, our goal is model 3. So we really don't need to dive into that page, but that just sort of highlights once again what the current asset allocation is. And then if we could skip all the way down to, go down to that page myself. Starting at page 17 on the bottom right. It is page 17 on the PDF as well. One more up. This will show you the fund's performance for the last quarter, but then it shows year to date, 1 year, 3 year, 5 year, 10 year, and then it gives some other indicators that are things that they evaluate the funds on based on their 13 criteria that they evaluate. And then it shows the net expense ratio. So that's the cost for the fund. So it will show you what those performance figures have done. That's one of their matrix. They obviously are not only evaluating the cost of the fund, but how's the performance been and how is it doing? And I'll get to that next. I know my time's limited. So if we could go to page, I'm just scrolling through. I'm going to go all the way down. It gives year over year performance, but I want to go to page 39. These are the 13 different criterias that they evaluate each and every fund on, and they track the funds. The funds will get a grade of either pass, watch, or we need to take action. Pass says it's doing fine. At least most of the categories get a passing green check mark. It's doing good according to InvestNet's analysis. A watch says that some of the areas aren't doing as well as they anticipated or had hoped. And so they're going to keep an eye on it. And if it has watches for 6 consecutive quarters, then it goes to, we need to take action. We need to remove or replace the fund. So on the next couple pages, it does it for every single fund. And I won't belabor this for you in the room, but if we just use, I'll go to the second page, the Vanguard short-term bond as a watch status. And the reason why is there's too many red check marks or X's for the different criterias that they're going to keep an eye on it. They're not real happy with it in layman's terms. And so they want to keep an eye on it. And they tell us the areas that they're not happy with it with. And so their job is to keep an eye on it. The next one is the BlackRock total return. It's on a watch status. MassMutual's total return was replaced. And so the fund that's replacing that is also on watch. And so please know that when they replace funds, they still scrutinize the new funds and they keep an eye and goal set and goal tend towards it. And so that's what's happening with that particular fund. If we go to, so that's the next couple pages for every fund. And then shows you year over year. And I apologize, folks, but it's 68 pages. So on page 58, perfect. This shows quarter over quarter for each fund. And so it will tell you if it's passed, if it's been watched, or if it's been had action taken against it. And so they do this each and every year. They do it each and every quarter. Bev gets the report as the plan sponsor. They give us a heads up each and every quarter how the funds are doing. But they are charged with that task. Any questions on InvestNet and their services offered to the plan?
Questions, Commissioner Martis?
Sorry.
Maybe that's just for my own edification. Historically, very few funds outperform the S&P 500 long-term. I presume that's just too volatile to have so many eggs in one basket like that for this purpose.
Yeah, it's a great question. The S&P 500, as you know, is passive. Their approach is going to be more of an active management style. They're charged with the task of any manager in the industry. Their whole goal is to outperform their respective index with less volatility. So their fee is worth it. The S&P is a hard one because, as you said earlier, there's many managers that don't outperform it at all. But there are fund families out there, and with folks like InvestNet's help, they can find those fund families and hopefully reduce the volatility for the plan. Are there any other questions? Okay, thank you for your time. I'll turn it over to Michelle.
Can we please pull up the 401A plan, which is the 780136 dash? Yeah, thank you. I appreciate it. And we'll go up to the top. Great. So for those of you that are new to the committee, I'm just going to do a little bit of a recap of what we've said already. Your plans came to Empower through the Mass Mutual acquisition, including me and my career. My career went to Empower through the Mass Mutual acquisition.
Thank God.
And we landed in a really good place.
Good.
So Empower is the record keeper, #1 record keeper in the government space. All of the clients that I work with are in the government segment as well as or nonprofit organizations. We not only serve the majority of the entities in that segment, but we are year after year after year recognized for our tools, be it the website or the mobile app, from a plan sponsor admin perspective. So how easy is it to administer the plan, as well as from a participant perspective. So unlike the DB plan, where it's really the burden is to educate the entity, the company, the county on the ins and outs of the plan, the 401A plan and the 457 plan, good would look like we have a very educated participant, because the burden, if you will, the ownership, the responsibility of growing and protecting those assets are on the participant level. So we're going to have a conversation about the plans. We're going to talk about plan data, but we're also going to talk about participant behaviors. Good looks like we make it as easy for you all to administer, as well as easy and compliant for you all to administer. But we're also always keeping on that participant education hat, because it really behooves them to be educated so that they have what they need to fund the dream of retirement based on whatever that dream looks like for them. It's very personalized. So that's what we're going to go into. The first plan that we're going to review is the 401A. If we drop to slide 2, the most important line here is to get a sense of the peer group. So we start to look at the plan data, and then throughout the executive summary, we start to compare the plan to a peer group, which in that bold line, your benchmark is 182 other 401A plans that are in the range of 10 million to 25 million. Okay, you don't have to read anything else on that slide. When we go to slide 3, we're starting to get better and better and better data analytics. So what this page is saying is that you're doing a wonderful job with housekeeping on the plan. There's a couple of data points that really matter to us. What are the age of these participants, and what's the salary of these participants? The reason is when we try to project the likelihood for them to be able to replace current compensation in retirement, we need those 2 data points. So kudos to the team, you're providing that data, and we're always going to take a look at that. When we go to slide 4, now we're starting to look at asset trends and participant count trends. So on the left-hand side, those are assets There's $23 million in this plan. As of this morning, it actually was bumped up to 24.3. So about $24 million in this plan. And you'll see that at the bottom on that left-hand side, there's two lines. One is plan level assets and the other is total assets. What it's telling you is that of the total population, $83,000 are plan level assets. So think about like forfeiture dollars. Someone had earned an employer match. It wasn't fully vested. They left the organization. Those monies went back into the plan account. So those assets are available to spend down based on plan design and policy and provision, usually to offset employer contributions and or to cover expenses. That 83,000, we want to keep an eye on. We don't like that to grow too much because it's opportunity for you all to kind of offset budget a little bit. So that's why I wanted to just spike it out for you. On the right-hand side, that's participant count. Fiduciary responsibility includes those who are active as well as separated from service. So we always want to keep our eye on the two populations, and we separate them because we engage with them differently. You all engage with them differently. So of the 522 individuals that have an account balance, 430 are active employees. Questions? Level of detail good? Pace okay? Okay, let's keep rolling. So now we're going to go on to slide 5. This is where you start to see a little bit of a peek into the benchmark, particularly average account balance. We like to, as an organization, just keep it trending on average account balance. Clearly, the higher balances, the more peace of mind participants will have at the point at which they're ready to retire. So we can see that the average account balance is trending in the upward direction. But when we look at that benchmark, or we look at that top 10%, think about your valedictorians, your best of your best of your best. That's your top 10%. We have a little bit of a discrepancy there. The middle column says, okay, of all the money that people are saving in this plan, how are they choosing to invest it? Now, remember what I said at the beginning, the DB plan, you all have a portfolio that applies to everybody's account in the DB plan. In this plan, participants decide and direct how they want those investments to go. So there are two extremes, and then there's that in the middle. So the one extreme is my total retirement, that is, do it for me. Help me with an accumulation strategy, help me with a spend down strategy. Think about that as kind of a subscription service. They pay a fee, but they have total peace of mind, and we'll go into a little bit more detail there. Conversely, on the opposite side, it's a let me just do it myself. In between, you have some risk strategies. One is the target date, based on my age, based on when I plan to retire, allocate my portfolio as I get closer to retirement, get that a little bit less risky so I can protect what I've accumulated. And then there's a risk-based strategy. So I don't mean to bore you with details. I just want to make sure for those that are new to the committee, you can see that there are 4 different options for participants to direct their investments as they like, and they can switch it over time. When we go to slide 6, we're starting to get more sophisticated with our data analytics. Thank goodness for AI. Thank goodness for data scientists. It's really cool what we're starting to be able to look at and view. So the first column is account registration. So think about when you log into an account, username, password field. We have about 50% of our employees or participants, I'll say, because they're not all employees, who have not registered their accounts. So that means that when you think about cyber fraud and bad actors, they love those blank fields because they can go in and populate whatever they like and wreak havoc on the system. We have an opportunity to promote some account registration education. Good would look like we have 100% accounts registered.
I just want to step in quickly because Bev and I do educational webinars, seminars, Zoom meetings. And earlier this year, we did multiple of them. We had a really good turnout, and I'm excited to see that raised the registration by 17%.
How much did it raise it?
According to this, 17% from last year.
Okay.
Yeah, so that means our drip campaign, I mean, we've been doing it for years. For those of you that have joined, I apologize. My voice sometimes is boring and I try to make it exciting, but we continue to do it. And it's just a matter of getting those that aren't comfortable, more comfortable.
And if I may, another piece of the puzzle is, once a year, we receive a list from our third party letting us know what employees do not have an online presence, they don't have an email account on file, they don't have a phone number on file, or they don't have a beneficiary listed. And we reach out to them individually with a memo personally, and then, the beneficiary form if they don't have a beneficiary form. And so we are reaching out to them in numerous ways. You can lead a horse to water, but we do try.
I will say that the new takeaway that I have just in the last 2 days with Michelle, I think the memo that we could draft internally. I think the memo that would probably consider drafting internally for this more recent wave would be around cybersecurity. Because if you start to tell people there's a huge uptick in cyber fraud, especially in retirement or investment or banking accounts, secondary authentication protects them. And if they don't register, Empower doesn't have that. If they don't provide a personal email, when they leave, Empower doesn't have that on file. So I think our next draft of that should be around, we're trying to help you protect your account from fraud. And that resonates with people because when you're told your money might be stolen, you tend to take action.
Good idea.
And good doesn't look like we put fear in the system. So we do have a security guarantee at Empower. It's actually very unique in the industry. So you having your account registered or not registered, either way. Other record keepers require you to have account registered, but either way, you have an account with a balance and you experience some type of fraud, we will make you whole. The only instance where we won't is if it's family-friendly fraud, and that does happen. In that situation, we let the family work that out. But if it's true fraud, we will make you whole. So we don't want to put fear in the system, but we do want folks to register their accounts. And on the right-hand side of the screen, this is why. We know, because we're in this space, one of the largest record keepers in this space, I already mentioned the largest in this government segment, we look for vital behaviors. We care a lot about people having what they need to retire with dignity and confidence in their planning. Our research shows that those that engage with their account, vital behavior, they engage with their account, save 4 to 5 times more for retirement than those who don't engage. Get to the stop sign, I turn left, I go to the gym. If I turn right, I go home. Vital behavior, turn left. For retirement planning, vital behavior is driving engagement in the account. We could look at the data and we see that we have about 40% of our participants have never logged in. So we can lift all boats if we can promote both registration and tool utilization. That could be the website, and we're seeing more and more mobile app utilization. Most of our participants are engaging with us through the mobile app. And we have videos and how-tos and training and education on both. So I do think that this slide would be a good reflection for those that like the tactical 2025, 2026 planning and employee education. Those are probably some data points that could tease out some good best practices. Flowing through slide 7, that's just the cash flows of the monies flowing in and out of this respective plan. Slide 8 is a graphical representation of the contributions going into the plan, combination of employer contributions, employee pre-tax contributions, and then the other, that teal, it would be like a rollover. We do not have Roth contributions set up on this plan right now. Slide 9 is the numeric for those that like numeric. And then slide 10, I offer you, but I'm going to throw a yellow flag on it. We're not going to use the data right now, but I want you to know that we could start to see, it's slide 10, please. I think we were at, where are the different views? Mine looks different than yours. I'm sorry. You're at a good spot. I'm going to catch up to you. The slide I was going to show you is about catch-up utilization. So a good data point for us to start to be looking at is, of those participants in the plan, how many of them are eligible to make catch-up contributions? And of those that can make a catch-up, how many are making a catch-up? Education opportunity, right? The reason I throw the yellow flag on the data is it includes terminated employees. And a terminated employee cannot make a payroll contribution catch up. So we're close to getting the data, but that's not going to be useful yet, but it'll be coming and we'll be able to have that conversation soon. This slide shows us, and thank you for taking us here. This slide shows us the average account balance. Most of them are below $25,000. Not likely to fund dream retirements. So we go to slide 14. This now shows us the investment and choices that individuals are making. Is there a slide before that one? Yeah, is there one before that? And then one more before that. Yep, this is a. No, that's it. Okay, so what we like on this slide is the, our numbering is off, so forgive us with the numbering, we'll figure it out. What's important here is, remember I talked about the investment allocation options from do it for me to, okay, let me do it themselves. We don't worry about those that are in the managed account strategy, the risk-based strategy, or the target date strategy. We know how those models work, and we know that those folks are fine. We care a lot about those in the do-it-themselves strategy. So that 188, we're going to drop down to the next slide, starts to show us, of the 188, how many of them are active. So the top portion of the screen are active employees. The bottom portion of the screen are separated from service. So that 188 now narrows down to about 151 of them that are active that we really want to care about. Now we're going to go to the next slide. This is going to show the correlation of their ages to their equity exposure. Theory is that as we age, we reduce the risk of our portfolio. So when we look at this, those individuals at the bottom, and I'm going to tease out a couple in their 30s and 40s that are green, those are active employees who are saving $1 today, that by the time they go to retire, that dollar will not have a dollar spending power. It's not going to keep up with inflation. So what I love about the reporting at Empower that we never had when we were at Mass Mutual is not only the plan trends, the benchmark trends, but we also now can get to a very specific individual, 32, 33 years old, 31 years old, and we can have a conversation with them. Good does not look like we force this person into the glide path. It may make total sense why they have chosen 0% equity, or it also might be, I didn't know. Thank you for reaching out and having the conversation. So we can pull reports by these individuals that are showing any type of inflation risk, and we can invite them to a one-on-one and some education and help validate where they're positioned. So I personally get pretty jazzed with this view. Questions?
Yeah, are we doing that? Are we reaching out to them?
It is a recommendation to do so.
Okay. Commissioner Martis.
From the various options of fund allocation, self versus professional, do we know long-term who outperforms the other? I would hope the professionally allocated ones, but.
That's a loaded question, and everybody's personal portfolio is different. So I don't have any metrics that lead to that. What we do know when we look at managed account strategies and target date strategies, and my actuarial partners can either correct me or confirm, they tend to have a higher return and a better performance over time. What we also see is that when there's market volatility, those in those managed account strategies don't bake in the losses. Oftentimes those in the do-it-themselves strategy might have some panic. They might pull their money out. They might move their money to cash. They bake in the loss. So, and then the timing of the market, they often will miss a day where they actually could recoup a lot. So that's what the data shows. You could chat GBT it. It'll tell you probably something very similar.
And to speak to that though, what I like about my total retirement is for the individual participant that doesn't want to go on one of our educational meetings, doesn't want to call me personally and talk about asset allocation or learn about risks of the market. They have another option and it's a pay for service. So they're paying a fiduciary to step in and manage their portfolio for themselves. In today's age, Michelle touched upon it earlier, we're in a subscription age where everyone's okay subscribing for their phone, their TV shows, their access to Amazon, things like that. Younger generation are okay to pay someone that has the expertise to do it. And we don't know what the outcome is yet because it's still too new. It's only 4 years in infancy, but the reality is in theory, those folks should outperform that participant if they did it themselves. We do have great target date funds though, and we've evaluated the target date. We have T. Rowe Price target date funds for those that don't want to pay an additional fee and just want to set it and forget it. The target date funds do that for that participant as well. And what I like about this is I see this trend here with a lot of the Lenawee County plans where we have older people with all equity exposure. Michelle gets a little nervous about that. I personally giggle because it reminds me that all of you that have a defined benefit plan are able to take a little bit more risk for a longer time frame because you have a guaranteed income. In the private sector, we don't see that because people don't have the defined benefit plans like you do. Okay, sorry, Michelle, go ahead.
No, next, please. We could skip the next two. That's more of the explanation of the equity exposure. Thank you. This is a good place to land. This shows you the uptick rate of the managed account strategy. So we went from 2023, 26 individuals now to 121. And I'm just going to take a little bit of a pause on the next two slides to explain the managed accounts to you just a little bit further. So if we skip to the next slide, please. One more. Thank you. Let's get back to target date. Remember I mentioned it's the age, my age and my year in which I'm retiring sets my portfolio. The managed account strategy is actually built on about 18 to 20 data points. It looks at things like the total household assets. It looks at where do we live in the part of the country from a cost of living perspective. It looks at our marital status. You could put in there personalized information, health condition, taking care of grandchildren, taking care of aging parents, having a career end early because of a diagnosis. You could put information of an adult child with special needs. These are the realities of individuals and families. The managed account solution allows for you to put in those data points. Therefore, your portfolio is not just based on how old you are and when you're retiring. It's really based on your personalized plan and the projections that the portfolio are going to need to, the income projections the portfolio is going to need to make up for you. Questions on that? Let's go to the next slide. Purple is good on this slide. So we have an opportunity to drive purple. What purple means is that those who are in managed accounts are going in and doing the personalization. Remember, I talked about all of those descriptors of your family. The tool has some default assumptions, but personalization is what we're really going for. So we're seeing that people are starting to do personalization, but another education opportunity, very targeted conversation to those in the managed accounts to helping them personalize those accounts. And then the next slide, we like to see these bars as big and long across this chart as possible. What this is saying is not only are they going in and doing the personalization, but now they're leveraging the power of these tools to do some household planning. When you start to bring in some spousal income and or other income, and you think about some of the other factors here, you're doing some household planning. Now individuals have some peace of mind. They have clarity of their retirement plan. Am I ahead? Am I behind? And I'm on track. And that's what we're looking for in this type of plan.
As part of the educational campaign that we'll continue to do throughout the year and years moving forward, I'm going to touch upon really driving home this point. If you're a participant in paying for this service and you're not giving them the critical data to actually allocate it properly for you, you're really paying for no additional benefit beyond what it could be. So to me, I'd like to see this number, when it says we've got 2-3%, we have 121 people. I'd love to see at least like 100 people go in there and put much more data for them to have a properly designed portfolio.
And then we'll wrap up this plan on slide 33, please. And there's a line item there that I like to get a little bit obsessed about. Oh, my numbers are different than yours. I'm sorry. Yes, Plan Insights is the title at the top. Be one above this, I believe. Thank you. Sorry about the scavenger hunt. There, I like to look for email address capture. I like to keep that number over 90. And as Beth had mentioned, we've talked about this in the past, and we'll continue to talk about it. We have 128 individuals in the plan where we don't have email addresses for these individuals. So what that means is, again, when you think about AI and you think about data science, we have very powerful personalized tools. We know that participants come to financial conversations, some with confidence, some without confidence, some with comfort, some with shame. The range is all over. So we don't want to overwhelm anybody. We always communicate best next step, the best next thing you can do. And we do it very incrementally. And we do it very personalized. That doesn't mean that my email is going to say Michelle and Becky is going to have the same email and it's going to say, hi, Becky. That's not what personalization is. It's very, very targeted best next step. Those folks that we don't have email addresses are not getting that. And so when we look at activity where someone has initiated a transaction, didn't complete a transaction, put conflicting information in, like joining 4 different target date funds, we don't have an opportunity to go and engage with them because we don't have their information. So a couple of recommendations for this plan in particular, some tied to the housekeeping, some tied to the personalized education for inflation risk, and some tied to the education on the managed accounts. Level of detail okay for you all? Okay. We could switch now to the 457 plan.
We do have the same.
It's up to
I'll
you.
look at the crowd. We have the same exact investment report for the DC. Sorry, Jim. We have the same exact type of report from Envestnet for the defined contribution 401A plan. I can go through that again if you want. And then we have the same exact type of report for the 457. So they've been hired for all 3 plans. We do it. If you don't want me to go through that again, we can let Michelle go to the next plan, which would be the 450.
We all set?
We're all set, other than I'm wondering, I think a number of people in this room may be part of the defined benefit, but there's also a large majority of our county employees who are now in the defined contribution. And even some who were in the defined benefit who have converted over to the defined contribution. And so I don't know if any of the findings are significantly different with defined contribution, but if there is, it would be interesting to hear. If not, I'm good with moving on.
From the fund level, you mean? No, once again, Envestnet is the 338, so they will just replace funds that are underperforming. There's going to be completely different funds than just the DB. There could be some overlap. For example, the DB does not have any of the T. Rowe Price target date funds because it doesn't warrant it, but the DC plans do. So that would be probably one of the major differences between the two.
So we're all set there. So I have one question on collection information. So how are these people communicating? If you don't have their email address, are they communicating our telephone? How are they communicating? Don't you require their email address if they're changing parts of their plan or putting information in?
We don't require email addresses upon account setup at that point. So an active employee may be using their county email address. Sometimes we have that and now they're terminated and we don't have their email address. Migration with Mass Mutual wasn't able to get to this level of reporting. And so a lot of the gaps that were in place weren't as clear as they are today. And so some of them are just legacy data gaps that we've had. What we like to do is get a cell phone number because that allows for 2-factor authentication. You log into your account, it pings your device. Yes, it's you, or no, that's not me. Let me report security. We like to have a cell phone number and we like to have an email address, be it personal or work, or both.
I would say in a perfect world, we'd like their cell phone and work and personal email, because if they leave work, we already have their personal email on file. It's one of those weird things though, Jim, I gotta be honest with DC plans, a lot of participants set it up at enrollment, set it and forget it. And it doesn't matter whether their target date or they picked a risk base or they pick a 60-40 weighting and pick their favorite 6 funds. They tend not to go back in and analyze it like all of us in the room would. They let it do its thing and it is what it is, but they don't rebalance on a quarterly or an annual basis. That's why Empower having tools like set up auto rebalance is really important, because if they're not going to do it, we want a secondary backstop that will do it for them.
Sure.
And so those are some of the educational things that we've gone through on the calls. Problem is I have a feeling that when Bev and I and Kim set up these calls, the same 40 people
Are there,
come back, and those that don't. And so we're not catching them.
Yeah.
Okay, well, we'll go to the deferred comp plan if there's another.
I know that we're talking a lot about emails and phone numbers and that kind of thing, but in order for somebody to actually set up the account, they have to have a physical address. So the physical address is on file with everybody. So there is at least that.
You get their statements.
It's not unique. It's ongoing. It's continuous maintenance. It's grooming. But I do see plans who do take action have fantastic results with capturing the missing data. And then it's just a little sweep at the end, getting anybody, the lost stragglers.
I know Michelle and I might disagree a little bit, but I do like fear. And I do, well, as an advisor of 30 some odd years, fear avoidance or loss avoidance creates action more than gratification. So if we send out a broadcast saying, we'd really like you to go in and register and update your account to protect you from any type of cyber fraud, we tend to get a better response than saying, hey, we've asked you before, would you please go in and register? It just doesn't resonate the same. And I apologize, Michelle, you're gentler.
No,
She's gentler and kinder, but
I don't inspire.
This is the good cop, bad
Right.
cop.
it's okay. I'll be the bad cop.
I hear you.
Can we please go to the other Empower presentation, 7A?
Wait, can
Oh.
you spend 1 second on
Oh.
that? I'm sorry. I'm so sorry. Yeah, this is important because there are funds that are being replaced automatically based on the fact that Mass Mutual is no longer offering those funds. So, and my speaker's on, yes. So on this report, you're going to see this list of current investments. They're automatically going to be replaced with the funds on the right. And so those funds have been selected by Envestnet to replace very similar weightings, very similar outcome. But the reality is those Mass Mutual funds are no longer being offered in the plan. And so Envestnet was charged with the task to find replacements. So they've done that. Beyond that, then there are funds that are on the watch list just based on those criteria that they evaluate, and funds that may have had actions taken against them. Those funds are replaced automatically by Envestnet. The rest is sort of very similar to what you saw with the defined benefit plan. Okay, I'm glad. Thank you for bringing that. Okay, next.
Okay, is this the 748-465? Yes, it is. Thank you. So this is a different plan type. This is a 457 plan. And I'll be full transparency, this plan is a little bit confusing for me because the data that I'm looking at. So I'm going to just share with you what we see in the data, and then hopefully together we could put together the story. So you already did. Okay.
For those of you that are new, do you know what a 457 is? Okay, that's why I wanted to
Okay.
do that. So you have a 401A plan that everyone's participating in if they're new, right? Because they're not in the defined benefit plan. And then for those that want to defer beyond what the 401A plan provisions allow, you have a 457. Think of it as an equivalent to a 401K for a municipality or a college or a church or a hospital. So if my plan in the 401A says I can only put away 5%, and I'm using this as an example, if I as an employee want to put away up to the IRS limit of pre-tax or after-tax, my only option in the county then is to go to the 457. So there's a handful of providers that are offered Empower is one of them. We have very, very small participation in this because this is really geared towards the person that wants to do beyond the scope of what they're already doing. And so with that, our data is going to look very skewed because of the fact that you have multiple providers offering the same 457 solution. Did I capture that pretty good, Bev, Kim? Okay.
Now,
Thank you, Michelle.
I'll just offer that we are seeing trends, particularly in the government's segment from an expense efficiency perspective, the plan consolidation. What used to be the trend of the multiple vendors is not the trend anymore. Now it's looking for an exclusive vendor. And that's twofold. One, to simplify administration. And then the other is to also improve the participant experience. It makes it easier to ensure that you have consistency of provisions. Multiple vendors, you might have a discrepancy of plan design across those vendors. There's fiduciary risk with that. You also can have confusion with participants. When an employee speaks to another employee, well, I did da, 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 da. Well, how did you do that? I couldn't see that. I don't have that tool. Now you have confusion in the system. So data shows, research shows, behavior shows going to an exclusive vendor is actually the trend. The other item is that with Secure 2.0, when you have multiple vendors, Secure 2.0 is pushing out over 200 provisions. Some are mandatory, some are optional. And you are required to update your plan documents based on the provisions that you either are mandatory taking on or opting to take on. When you have one vendor, you have one plan document, $1,500. When you have multiple vendors, you now have that expense over and over and over. So there is absolutely an economic play, and then there's a simplification play in that. So this plan is a 457 plan. The benchmark is 1,719 other 457 plans that are below 5 million. When we go into slide 3, this plan, unlike the other one, we don't have anybody's salary information. Now, there's only a handful of people in this plan, but this plan means a lot to these individuals. This is extra money that they're putting in to retire. And when they go into the tool right now, we're working off an assumption of $50,000 salary. That may be correct for them or it may not be correct for them. So when they go in and they see any data, the likelihood to replace your compensation, we don't have the right compensation number for these individuals. Very easy in a once a year upload, share us salary information, and we can get this to 100. When we go to slide 4, this shows the assets in the plan. This is a much smaller plan. So I don't know what the total population is of your employees or participants that participate in all of the 457 plans, but this plan only has 7 individuals. It is 6 active employees and then 1 separated from service. When we go into slide 5, which to me feels really low, I'm assuming that there's a larger population in some other plan that may or may not be designed like this plan. Average account balance, though, is doing very, very well. So you can see the growth in average account balance, which is wonderful for those individuals. But look at the difference in the investment strategy on this one. All of them are only in a do-it-themselves strategy. That's the only investment strategy offered in this plan. That can be adjusted. We can add target date. We can add managed accounts. We can have it look similar to your other plan. But when you think about participant experience and you think about simplifying their education, the more consistency where we can have it just makes it easier for people to understand. So this surprised me a little bit that we only have the option of do it themselves.
Once again, sorry to hate to interject, but the history of this is this was an old Hartford plan where we had 7 people in the plan, only 1 actively contributing, currently contributing. So there's only 1 person putting money in. When we reached out to that individual about fund options, they did not seem to be worried with the fund that they were in. So we did not go through that exercise of adding all new funds for a participant that quite frankly wasn't requesting it, but we're happy to do so when the plan up if that's something that the committee would want us to do.
And then when we go to slide 6, this is that view of registration and login activity, very similar trends. So I think if we do a exercise on one plan, might as well do it on both of them, promoting account registration and then trying to encourage the login activity. Cash flows are on the next slide. That's the money going in and out of the plan. And then you start to see the graphic representation on the contributions on the next slide. Again, these are all participant pre-tax contributions going into this one. And then the distribution activity, if you wanted to see the graphic there, again, very small. So you're going to see onesie twosies, and then we'll just continue to the next slide, which is your loan activity. Although the loan activity is really north of benchmark, don't worry. The data doesn't show that. If you go to the next slide, it doesn't show that there's any loan activity of recent. So people aren't trying to deplete these accounts to cover current expenses. If we did see data that looked like that, I'd probably be recommending a debt spend down education class, or something like that, like a budgeting class where they can learn how to do that a little differently than hitting the retirement account. But you're north of benchmark, well north of benchmark, but I don't think there's any gap from the recent trend that would signal anything for you. Account balances is on the next slide. If you're ever wondering what are the balances of these individuals, you can start to see that a little bit. And then we've already talked about the investment strategy, 7 individuals in the do-it-themselves strategy. Like we talked about before, how many of them are active? The next slide will show you that there's 6. And then when we try to say, okay, of those 6, how is their age and equity relationship and ratio mapped out? The next slide will show us that they're actually doing pretty good. There might be one individual that we'd want to have that one-on-one conversation with. But like I said, good doesn't look like you force them to the glide path. Good looks like you just have care and you do some outreach. Of these individuals, we'll close out with the plan insights slide. 2 of these individuals, we don't have their email addresses for, and of a small population of 7, it drops us to about 70%. But if we can capture those 2 email addresses, we'll probably be in good shape. Questions for the group? I went through that a little bit quickly. They don't, would you be able to get to empower.com Learning Center? I'm not projecting my screen. I don't know what capabilities they.
This is great. For everyone in the room, you have access to this. This is the Empower Learnings. You want to do Learning Center?
Could you please click Learn? Your view's a little bit different.
She just said empower.com. So just type in Empower Learning Center in the search engine and it should pop up. Without the www, just Empower Learning Center. And it should pop up. Yep. There we go.
Great.
So this is the web page that everyone has access to 24/7. You can see that they have all different types of tabs or tiles that you can click on. Within each of those, there'll be a drop down where they will have video vignettes. They'll have educational materials. They'll have worksheets, workbooks. They have live webinars every month. So you can click on October, register yourself, your personal email. They'll send you an invite. You can join. If you can't watch it, you can watch previous recorded ones. Every time we do an educational session, I highlight this and walk people through it because it's very, very, very poignant, perfect timing information. They do it based on what's going on within the world and what's going on within people's personal finances. I would encourage that beyond some type of employee intranet page, so it's just constantly broadcast. You're probably already doing it.
I'm sure everybody here remembers seeing emails
addressing this.
So these are some of the tools that Empower brings to the equation that Mass Mutual never did, and they're fantastic. I use these with clients that aren't even clients of Empower because Empower has made it available to the public. And I just wanted you guys to see what it looks like, but it's very easy and user-friendly to navigate. Thank you.
Thank you for navigating. And that was all for the prepared remarks. I'm willing to talk about questions or work through questions if you had any.
Any questions? Okay. Anything else from the committee?
I apologize for missing part of the presentation earlier. I had to take a call. It was a little lengthy. One of the things I don't know if we mentioned, and Ms. Ehlers, I know you and I have talked about that, is, and it was referenced a few minutes ago, the 457 plans. And we were talking about what that looks like, the number of plans we have, and whether we should consider reducing those plans. Are we at a point where we want to talk about that quite yet, or is that something for a future meeting?
I think this would be a great opportunity to talk about that. We have a number of vendors that employees are allowed to participate with if they want to, with employee contributions only, no employer contributions. Lincoln National, Nationwide, Empower, Gleaner, and Mission Square. Currently, we have 12 active employees in Lincoln National, 9 in Nationwide, 1 active in Empower, 8 active in Gleaner, 0 active in Mission Square, for a total of 30 employees out of around 570. So we do not have a lot of participation in the 457 plans. And as Michelle referenced just a little bit ago, having, once upon a time, it was a great thing to have so many options. Now, having so many options is overwhelming to the actual employee. Which one do I go with? Which is the best one? There are different options. Downsizing that a little bit might make it more popular for employees to participate with. And I will also add suggesting a Roth option as well, because none of these plans offer a Roth option.
Commissioner or Administrator Murphy.
To continue on, as we look at this, it's beyond us to necessarily make a recommendation, especially if there are participants in the various options that we have, to say, well, we're only going to go with these 2 or these 3. And so one of the things that we have been considering is what does that look like? And would it be best to create more of an RFP type document that says, if we are interested in offering this particular program to our employees, do a request for proposal. What does that proposal look like? What kind of benefits can you bring to the table for the employees? And bring that back to look at, to see if that will help guide us into the plan that would be the better plans for our employees. So I know that we were looking at that. I don't know, again, Ms. Ehlers, you've been working on this more than I have. I don't know if that's something that we're looking for this committee to direct us at yet, or if we'd prefer to schedule a meeting maybe after the first of the year to get into that in a little bit more detail.
A meeting after the first of the year, I think, would be a great idea.
Please know that Michelle and I'd be more than happy to engage in that. I know we only have 1 active participant. Well, one of the benefits that Empower brings to the equation is you have the other plans with them. So there's some economies of scale from an administrative standpoint, a plan expense standpoint. And quite frankly, it's just easy for a participant that's already in a DC plan with Empower. If you did decide to go with Empower, that they'd have 1 login and they'd have access across all 3 plans for that matter.
I think we have had those discussions, and you're right. When you have too many options, it's impossible for us to educate employees on each plan and the benefits of each plan, or which plan is better. We don't want to get into that situation. And so, and in any case, having the multitude of plans that we have right now, if we reduce that, we are going to be requiring employees to either take that plan and go on their own with that or move it to one of the plans that we go with. So we want to make sure that we are fully educating ourselves on the opportunities that are there for our employees. And again, yes, I think somebody over here referenced it earlier too. The Roth option is something that we have heard a lot about from our employees and are interested in having that included as an option also. So we will look at the committee to maybe schedule something after the first of the year and come back and
Good.
have some of those very pointed discussions.
Okay.
In fact, Kim, the easiest, cleanest thing is if you have vendors that have no account balances, no active participants, remove them from the list immediately, because if there's no assets, there's no required action. You're just not approving them as a vendor moving forward. They might have been on the books. I'll use Rochester Community Schools as an example. For many, many years, they had like 20 different vendors. Well, you'd have paralysis by analysis for the teachers because they'd walk into a room like this and they'd have all 20 of us in a circle. And by the time they'd get to me, the person's eyes were glossed over and I'm like, this is the craziest thing. So you might have old inherited 457 vendors that have no activity, no accounts. Those are the quickest, easiest to clean out.
Deputy Piper.
Thank you for the demotion. It comes with much less responsibility. So thank you very much.
Captain.
I like that one better. I like that better. I'm interested to know the employees who participate in the 457, how many of them are in the defined benefit as opposed to the defined contribution? One of the conversations that I hear from our employees are, if they're in a defined benefit, then this is an extra account for that retirement. Those who participate in the defined contribution want to have all of their money in one. So they want to combine that money so it works for them better. So having two separate accounts is they're not moving that way. It's not, I don't know the term I'm trying to say, but they want it in, it's not as desirable.
I could speak to what we see. So from an Empower standpoint, this might feel self-serving as I share this with you, but the reality is one login, they log into the Empower tool. They can see both plans in detail. But remember I talked about personalization and I talked about the likelihood to replace current compensation in retirement. The tool is smart enough to take all our buckets and all our pockets and give us a total and make the plan on the total. It takes the complete burden out of the individual's head. It puts it all on a dashboard. You could see it numerically, you could see it graphically, you can even run scenarios on it. So individuals might have some pre-tax dollars. It's all through payroll contributions, and your contribution slide is one screen. So it would show pre-tax, it would show after tax, and you can select what you want.
That's not what I'm asking.
So
I
are you
don't-
asking help with the confusion of them putting money into the two different plans and
Yeah,
how
so-
can they keep track of that?
No, not keep track of that. If they have two separate plans, this plan is growing at this rate. This plan is growing at a different rate. If you combine that money, now you have more money working at that rate. So you have two small accounts rather than one large account. That's what they're.
Oh, compounding the value.
Are you, can I paraphrase? Are you saying they'd prefer something like a 401k where there's one account and they get to put pre-tax, post-tax rollovers in, not separate?
The discussion is that
I think that what you're looking at is they want to be able to put all of their money into one place at one time. And so I think that is essence an increase in, right now, we're limited at 5% of our contribution. And I think what you're suggesting is employees are saying, why am I limited at 5%? If I want to put more money into that, because that's the one I understand, why can't I put more money in there? Is
Yeah.
that some of what you're going
That's-
after?
Yes, that's partially what it is. So they want to put 10 to 15% in. They don't want to put it in two separate accounts. They want it in one that grows at a larger rate because of that one pot of money.
So that suggests perhaps an educational opportunity as well, because the different, so we have not alphabet soup, we have the number soup of the Internal Revenue Code. There are different types of defined contribution plans that have different abilities and restrictions on the 401A plan, the sort of basic defined contribution plan doesn't permit the extra contributions. You have to have a second plan, the 457 plan, in order to enable people to save that extra amounts. That's just a function of the federal law that governs pension plans, but it might be something that it would be a good discussion with your employees so they understand why these different numbers, what are these different types of plans?
And that's why I'd be interested in the difference between those members in defined benefit who are participating in 457 and defined contribution, because it's probably more of an education on their end.
And along those lines, the consistency in fund lineup and investment strategy is helpful. So if someone is in one plan target date fund and they go into the other plan to try to get into that same target date fund and it's not offered, that's where that can be confusing. So the more consistency we have in the fund lineup, the more consistency we have in the investment strategy, the education on the plan types and the IRS restrictions, and how do you play your chess game based on what you need to do for your planning, that can solve some of that. That was a great point.
So you'll work together to get that scheduled after the first of the year?
Yes, we'll work on bringing a retirement committee meeting together after the first of the year. To talk
Specif-
about
Specifically for reducing,
the 457 plans and considering whether we want to do a RFP to get best practices going forward.
I wonder if it would be, and it may be too complicated, if we would invite all of those that have money in there and, or at least announce to them that they know this committee's meeting over that. Or would that get confusing with them wanting to ask questions?
You mean the vendors or the employees?
Employees.
I don't see anything wrong with letting our employees know. In fact, we would want to be proactive with that and advise them that.
Right.
And as you saw, I think we're limited to just a small handful of individuals that are currently investing in the 457s. And one of the reasons we were having these conversations is to try to encourage more participation. And so bringing those plans actually to light, bringing them before and talking about, here are some of the benefits of the plans that you may not have been aware of, and kind of addressing what Captain has indicated, we may be able to get some more participation in these plans too. So I think there'll be more of a deeper discussion on that once we get something figured out first quarter of 2026.
Okay. Commissioner Martis.
I think I may have understood Captain Pfeiffer to be asking this as well. Do we know of the people in the 457 plan, what percentage of them are in the defined benefit plan? And
No.
adding that?
I don't. I've not looked into it. I've not cut it down that deep. I can tell you that in most of the plans, there are a number of retirees as well. So, you know, they're silent in terms of being active and continuing to contribute, but they do have balances in there as well.
Thank you.
Okay. Any other questions? Any other action to be brought before the committee, other business? Administrator Murphy.
Not an action item here, but I know all of you have either flown in or you spent a lot of time getting here. You came last night. I just want to say thank you for the amount of time that you put in towards our plans and making sure that our employee investments are being well taken care of. So just thank you for all your time and effort. And Jason in particular, I know that you attend all these meetings with Bev and I and our employees, and I do appreciate the effort. So thank you.
Yes, and I would echo that, and I think the presentation's very professional, very straightforward, so appreciate that. Go ahead.
Congratulations, Becky. It has
Yeah.
been wonderful working with you.
Thank
You
you.
will be
It's been
missed.
my pleasure as well. I'll miss you, but I know I'm leaving you in Jack's great hands.
Thank you. Anybody else? Public comment? I don't see any public here. Or yep, I do. Public comment? Motion to adjourn.
Support.
I have a motion by Commissioner Bartis, supported by Administrator Murphy. All those in favor signify by saying, oh, Jacob, just one thing, just know, everyone will know you're a captain from now on, so. say that. All those in favor signify by saying yes.
Yes.
Opposed, no.